Hello and good morning. You tune into Market Cafe. I'm Ankita Saxena and with me is Nupur Talwar. In the next half an hour, we'll take you through all of the transpired on the global front, the US markets, and of course the cues you need to watch out for back home before the start of these streets. Without further ado, let's get going with the show and talk about how the Wall Street shaped up yesterday. Now, remember, we had that important Fed meeting yesterday, and the Fed has kept its rate unchanged between 3.5% to 3.75%, and that really, sent the bond yields on a tizzy. In fact, the 30-year bond yield spiked 10 bips, and it was sitting above the 5.2% mark. That hit the highest level since 2007. And you remember that whenever the bond yield spike, that has a negative impact on the markets. And on account of that, we did see the US markets that were in the red. In fact, major cuts coming across. Dow Jones, that was down more than 1,000 points. It was down 2%. S&P 500 was also down 112 points, 1.5% downtick coming in on S&P 500. Nasdaq also saw a drawdown of more than 1.5%, almost 430 points of a downtick coming in as far as Nasdaq is also concerned. Now, as far as the commentary is concerned, though, Kevin Walsh did mention that perhaps there could be a possibility of a cut in September, but for now they have left the rate unchanged because there are possibilities of higher inflation on account of the energy and oil supply disruption. And on account of that, we did see the US markets at least seeing a drawdown in the trading session.
Right, absolutely. As Ankita is pointing out, of course, all of those also playing on the crude oil prices. Now, crude oil prices have risen sharply Wednesday, also after the president said that the US will hit Iran hard in retaliation for an attempted surprise attack on American forces in the Middle East. Now, Brent oil jumped back above $90 after Trump threatened to hit Iran hard. Gold has also climbed towards $4,100 an ounce on Thursday. This, of course, is building on the previous session's gains after the Federal Reserve left interest rates unchanged. This has been despite mounting inflationary pressures stemming from renewed conflict in the Middle East. Now, the decision, of course, has offered some support to the bullion as higher interest rates tend to weigh on demand for non-yielding asset classes. Let's do a quick check of what's happening in the Asian markets right now. Now, Nikkei also trading about 2% or so above. The Shanghai also trading above at this point in time. The Kospi also doing very well. Now, the Nikkei has been gaining. It is ending a two-session losing streak as investors have responded to the US Fed's decision to leave interest rates unchanged. Now, the benchmark Kospi has also risen, recovering part of the previous session's losses. In fact, this comes as Samsung Electronics has rallied after reporting record quarterly earnings. Now, Samsung has climbed nearly 3% after posting stronger than expected results with record semiconductor operating profit driven by robust AI-related memory demand and forecasting continued strength in AI infrastructure spending.
All right, so that's what the Asian handover looks like. A mixed, Asian handover is what it looks like, and the implied start to Nifty is implying to start of a cut of almost more than 50 odd points on account of the escalating tensions and the crude price tick up. We are expecting a cut of almost 60 points at the start of the day. But let's move on and talk about the US Federal Reserve that has kept interest rates unchanged at 3.5% to 3.75% for a fifth straight meeting. But the decision was far from unanimous. Three policymakers voted for a 25 bips hike, highlighting persistent inflation concerns. Fed Chair Kevin Walsh reiterated the commitment to the 2% inflation target, but stopped short of signaling the next move, leaving the markets divided on whether a September rate hike is still on the cards. Let's go across and listen into what he had to say.
Our committee decided to vote by a 9-3 vote to maintain the target range for the federal funds rate at 3.5% to 3.75%. The committee is continuing its policy of making ample reserves in the banking system. The economy is showing impressive resilience. Even with recent shocks, the trends are positive and reveal solid growth. Job gains have kept pace with the workforce, and the unemployment rate has changed little. Inflation remains elevated relative to the committee's 2% goal. The committee remains resolute. You've heard this before, but we will deliver price stability. As before, the policy statement conveys just the facts. It's steering clear of forecasting. a choice we consider especially prudent at these uncertain times. 5 years of high inflation have left a mistaken impression that's hard to shake, that the Fed's implicit inflation target was somehow above 2%. Let me reiterate, there is no soft inflation target. There is no soft implicit target, not on this committee's watch. There's only a target, and it's 2%. Not one of my FOMC colleagues is under any illusion. We have begun a new chapter, and we understand that the 5+ years of inflation above target cannot be cured in 9 weeks or by a single month of modest price decreases. There was a large majority support for the decision that we made in the room, but I also want to leave you, Claire, with one other impression. There was nothing inertial about that discussion. It was an active, robust discussion about what's in the full range of what we can do and might want to do in the period ahead. You characterized accurately there was a disagreement about a decision today. I would say that doesn't sort of capture the full essence of the discussion. The path to central bank heaven requires delivering on our remit. These days, that means delivering on price stability.
All right, so price stability over there, a great concern for the Fed. But let's quickly look at what happened in Korea, which has led to this ride of nearly a 5% in the Kospi. Now, Samsung Electronics, of course, reported a record second quarter with operating profits surging over 18-fold on the back of booming AI chip demand, and that is why the Kospi is trading about 5% higher. Now, while revenue came in slightly below estimates, operating profit beat expectations. A strong sales of high bandwidth memory chips powered its semiconductor business. Now, Samsung also expects its AI-driven demand to remain robust in the second half of the year.
And keeping it with the earnings, then Meta shares fell after hours of trade despite beating the revenue estimates as investors focused on the weaker than expected earnings, softer revenue guidance, and a sharp decline in the free cash flow. Heavy AI infrastructure spending continues to weigh on profitability, with free cash flows dropping $784 million from an $8.5 billion a year ago. The company, however, remains committed to expanding its AI investments.
Microsoft shares surged 7% in after-hours trade after the company delivered strong earnings beat powered by accelerating Azure growth and robust AI demand. Now, revenue has topped expectations, with Azure growing 43% comfortably ahead of estimates. The management has also reaffirmed its AI investment plan, saying capital expenditure will continue to rise to meet strong demand across cloud and AI businesses.
And Starbucks shares jumped as much as 9% after the coffee chain reported a strong quarterly beat and raised its full-year guidance. Same-store sales rose 7.9%, comfortably ahead of the expectations, as CEO Brian Nichols' turnaround strategy continued to drive higher customer traffic and spending. The company also lifted its earnings and sales outlook for FY26, signaling confidence in sustained momentum.
The West Asian conflict has escalated once again, with the U.S. launching fresh strikes on Iran after Tehran fired ballistic missiles at American forces in the region. Now, while U.S. officials said all incoming missiles were intercepted, President Donald Trump vowed a forceful response, saying Iran would get a beating. Now, the renewed hostilities have revived concerns over regional stability and potential disruptions to global energy supplies. Listen in to what he said.
I'd like them to add Iran as tariffs, not just as sanctions. I think it's important. That's what Lindsay wanted, because I heard that they have tariffs on Russia, but not on those 5 countries with having to do with Iran. I'd like to see tariffs on Iran. It would make it much stronger. So perhaps you're very good at this. You can maybe tell them. I think they should put in for Russia, but I think they should put in for Iran. And that's really what Lindsay wanted. We're going to hit them very hard. I mean, I can actually say that, because in that, there's very little they can do about it. It was a different group than we're dealing with. They've already apologized. But, you know, we got to smack them a little bit.
And while the government has expressed confidence that the proposed India-US bilateral trade agreement will be conducted once India's demand for a comparative advantage is addressed, officials said that both sides have already finalized several aspects of the pact while discussing While discussions are still continuing on the outstanding issues, including the ones that are related to Section 301 investigations. Now, the government clarified that the U.S. tariffs stem from one investigation, with other aspects of the probe still under discussion. Now, it, however, declined to comment on the speculation surrounding the proposed U.S. sanctions bill linked to the purchase of Russian energy, saying that the negotiations with Washington are continuing. Let's listen in.
I have very categorically and on several occasions expressed the confidence that what we have finalized with the US as the first tranche of the bilateral trade agreement, which was announced by our leaders on 3rd of February, will come into operation as soon as the United States is able to ensure that we get a comparative advantage over our competitors, the countries in our neighborhood, the countries in the ASEAN region and other countries with whom we compete. That was the basis of our first tranche of the BTA. And once that basis is re-established, the US BTA will be ready, up and about.
And more than 250 of India's top technology leaders are set to gather in Jaipur for the 27th ET Edge CIO and Leader Conference, where the focus will be on agentic AI, the next evolution of enterprise AI that can act autonomously rather than simply assist. Now, the 4-day event will bring together CIOs, CTOs, and digital leaders to discuss AI governance, cybersecurity, deployment at scale, and how businesses can generate more and real returns from AI investments.
Welcome back. You tune into Market Cafe. We are taking you through all the cues you need to watch out for before the start of the street. And since we are in the thick of earnings season, let's talk about the earnings. And one of the earnings candidates that saw a good quarter was Eicher Motors, that reported a PAT that was up 21% on a year-on-year basis, whereas the EBITDA beat the street estimates. My colleague Avi is now joining us with all the number crunching for Eicher Motors. Over to you, Avi.
So Eicher Motors has come out with its Q1 FY27 numbers, and let's have a look at the 6 most important points. Starting off from the financials, the numbers are good with the revenue and profitability in line, and EBITDA being a beat on the estimates. The margins have also held its place at around 24%, which was our estimate at 23.9%. But the standalone margins for Royal Enfield have seen a contraction of 80 bips on a yearly basis, but in line with our estimates. Up next is the news that the Royal Enfield is now participating in the EV race and have launched their first EV motorcycle, the Flying Flea C6, and have made 100 deliveries in the past 2 months. Another big news from Eicher Motors is the capex that they've announced of 2,500 crore rupees, and that is a greenfield capex in Andhra Pradesh. They will take their total production capacity to 24.5 lakh motorcycles per year by FY30. So that is a big news coming in. The margins have seen a headwind of 4 to 4.5% on gross margins in Q1 due to commodity cost inflation, and margins can also be seen under a pressure going forward in Q2. But the international business has done very well and has crossed 1,000 crore rupees for the first time, making up almost 15% of the overall revenues. The Brazil has been the biggest export market, while green shoots have been seen in the US market post the trade deal. Our last pick would be the non-vehicle business for Eicher Motors, that is the accessories, spares and apparel, growing at 30% and making 15% of the revenue for Eicher Motors. So all in all, a good set of numbers with EBITDA beating the estimates and the revenue and profitability in line, with margins coming in at 24%, which was what we expected here at DT now.
And in fact, sticking with earnings, Asian Paints reported a better than expected first quarter, with revenue, profit and EBITDA all beating estimates. Now, management has maintained its FY27 volume growth guidance of 8 to 10% and expects industrial coatings to outpace decorative paints, even as competition remains at an all-time high. Now, Ravinder is joining in with the con call highlights that took place and the brokerage verdict. So, hi Ravinder, good morning. Give us more of what you understood out of it.
Good morning. Yesterday during market hours, Asian Paint reported its number, and the number was above the street estimate, and on a yearly basis, it was a strong number. And in the con call, management remained optimistic about the demand outlook. They highlighted that the rural market continued to outperform the urban market, and the company also noted that the premium product are now witnessing a strong acceptance in tier 2 and tier 3 and tier 4 cities. And on the pricing, management expect value growth to continue to outpace volume growth over the next few quarters as recent price hike continue to support realization. And on the guidance, management sticking to the guidance of EBITDA margin 18 to 20% for the full year of FY27 and volume growth guidance of 8 to 10% on for FY27. And if we talk about the brokerages, now brokerages remain divided. Citi has maintained their sell rating with a target price rupees 2,650, stating that the Q1 volume growth was aided by low base channel stocking ahead of the price hike and an improving demand environment. The brokerage believe that the further re-rating depends on market share trends and sustainability of the margin of Asian Paint, whereas Nuvama has maintained their buy rating with unchanged target price rupees 3,470, highlighting that Q1 marked the first positive volume and value gap in 14 quarters and expects FY27 to remain positive volume and value gap year. UBS has maintained the neutral rating with target price rupees 3,080, and apart from this, on the positive side, JP Morgan has maintained its overweight rating with the target price rupees 2,970. Jefferies has also retained the buy rating with target price rupees 3,350. So overall, management also remain optimistic for the growth in FY27 in the con call.
All right, so that's the verdict coming in for Asian Paints. Do watch out for Asian Paints in the trading session today. And speaking of the consumption pack, let's shift focus to Dabur also, that reported an inline first quarter that where the revenue grew in double digits for the second straight quarter. The management remained optimistic for FY27, guiding for a double-digit revenue growth and better margins, while the brokerages also remain constructive on the stock. My colleague Shesha is now joining us with the brokerage verdict.
Well, yes, so Dabur has reported largely in-line set of numbers. Volume growth for the quarter gone by has come in at 5%, sequentially lower versus 6% that the company had reported in the previous quarter. And this is the second consecutive quarter when the company has reported strong double-digit growth of about 11% on the revenue front. But let's put the spotlight on some important commentary that came in from the con call. And first up, they've spoken about rural demand, where they say rural demand continued to outperform urban demand in the quarter gone by. Inflation is concerning a tad bit is what they've said, but they expect to navigate the season despite the turmoil they are facing as a result of inflation. They expect consolidated double-digit revenue growth for the full year FY27. They have maintained their revenue guidance for the full year. They expect margins to be better in FY27 as compared to FY26, and they are targeting mergers and acquisitions in the D2C space over the next 3 years. Brokerage houses, meanwhile, have come up with their view. Nuvama has retained its buy stance, and 620 is their target price. They've largely kept their estimates unchanged for the year. MK, meanwhile, has an ad rating on the stock with a target price of 470. They say they believe international business reported strong growth of 16%. They've marginally changed their estimates. They are now expecting sales growth of about 9% over the period FY26 to 29, and weaker than expected monsoon, meanwhile, is likely to impact rural demand over the next few quarters. So yes, numbers largely in line. Commentary is also not negative. Brokerage houses too continue to remain constructive, and most of them have not changed their target price.
All right, now, in fact, Prestige Estates has reported a weak first quarter, missing estimates across revenue, profit and EBITDA, as a high base and lower realizations weighed on their performance. Management maintained its FY27 guidance, backed by a strong launch pipeline and healthy momentum across its commercial, retail and hospitality businesses. Rabinder is joining in with the highlights of that. So, Rabinder, tell us more, please.
Well, yes, it was a weak quarter for the Prestige Estate in Q1 FY27. On the revenue front, company's revenue rose by 16% on a yearly basis to rupees 2,675 crore, but it was below the street estimating. And the company's margin also declined to 32.1% on a yearly basis, and the margin pressure was primarily driven by a 30% increase in the contract cost and employee expenses, while finance cost also rose 9% on a yearly basis, impacting the overall profitability of the Prestige Estate. And on the operational front, residential pre-sale declined 46% on a yearly basis, largely due to a high base as the Indirapuram project was launched in Q1 FY26, and average realization also fell to 16% on a yearly basis, reflecting a change in project mix. But despite this weaker bookings, collection remained resilient with 6% on a yearly basis growth of the Prestige Estate. And the commercial, retail and hospitality business segment of the companies continue to perform well, supported by healthy leasing, a strong malls footfall and robust travel demand. And if we talk about the guidance, the management in the Q4 con call has given a guidance of pre-sales, and for collection they are expecting a 15 to 20% growth, and residential revenue recognition of 12,000 to 13,000 crore, and EBITDA margin of around 25%, and a plant launches with a GDP of rupees 58,000 crore for the FY27.
All right, so that's the lowdown for Prestige Estate. But let's also talk about KPIT Tech that reported a weak quarter. The management expects profitability to return by Q4. My colleague Darshita is joining us with the roundup for KPIT Tech.
Right. KPIT Technologies had already flagged a weak quarter in its business update earlier this month, guiding for a 1% decline in the US dollar revenue. The actual decline, however, came in at 0.6%, where the management saying that the quarter performed slightly better than the outlook it had shared. Now, even so, the overall earnings remained weak. Revenue was largely in line, but EBITDA, EBIT and the net profit all missed the street expectations as the margins came under pressure. Now, the important commentary coming from the con call is that the Q2 is expected to remain flattish, but the company expects the growth to improve from Q3 with a stronger recovery in Q4, making the H2 FY27 better. Now, management also highlighted that the healthy deal wins of $257 million contributed traction in its products and solution portfolio, and said that the AI-led productivity fixed price contracts and the vendor consolidation should support the margin recovery going forward. Now, the brokerages also remain measured. Goldman Sachs has maintained a neutral rating with a 637 rupee target price, saying Q2 is likely to remain similar before a stronger second half. Now, focusing on the domestic brokerages, Motilal Oswal has retained its buy rating by cutting its target price to 730 rupees, citing near-term weakness in the global automotive sector and the delayed deal closures and the continued pressure on margins. So yes, overall the quarter was weak. The street's focus now shifts to whether KPIT can deliver the H2 recovery that the management is guiding for.
Darshita, thank you very much for joining us on that one. And in fact, that's all the time we have right now on Market Cafe. From Ankita and me, it's goodbye for now.